Hi, I'm Scott Lucas with Lucas Financial Services and Wisdom Tax Group, and today is Wisdom Wednesday. One of my favorite subjects is really the psychology and how we think about money. Um, it's been decades that I've been in this business, and I found that that's really the determining factor is really more about how you process and how you think about money versus just actual economics. I'm not saying that that's not important, but I'm saying that investor behavior is going to be a bigger deciding factor. The message I wanted to talk to you about today was I wanted to discuss an investment that had the best returns during the last decade, but the average investor lost money. You wonder, how could that be? So first of all, the last decade was considered January 1st of 2000 through December 31st of 2009. So it was basically a 10-year period in which the S&P 500 index basically had a flat return. It was basically zero return over that decade. That's why they called it the lost decade. During that time period, we had the dot-com bubble, which was, one of the biggest, declines in market history. And then we had a second one during the credit crisis of 2008. And those two were only less significant than the Great Depression of the 1930s. So during that time period, investors had a very difficult time period. However, this particular investment, or this particular money manager by the name of Ken Hebner, averaged 18% per year. And the stunning factor is that they track the results of investors and the money flows in and out of the fund. And they determined that the average investor lost 11% per year in that. So you're wondering, how could that be? Well, the answer to that is the fact that the volatility of the fund was so significant. It had these big upswings and then it had these downswings. One year it was up 80% and then it declined 48. And so investors would say, oh my gosh, look at the returns. And they would jump in and then they would have this loss and they feel like, oh my gosh, I just got to say, stop the bleeding, sell the investment, and they would lose money. And so they had permanent losses. Instead of looking at how that money manager performed. It was a very rough ride, but it was a very successful ride over that 10-year time period. Like I said, it was the very best performance of any mutual fund out there, but investors had horrible results. Imagine when they read, about that fund and they're like, "Oh, hey, it was terrible. It didn't do anything for me." So let me bring up that article just to show you. So this was a little technical issue here. Here we go. So the best fund of the decade, there you see Wall Street Journal was written December 31st, 2009, rose 18% per year. Investors lost 11% annually. Referencing the big swings, had a small stock portfolio, only about 25 stocks, but here they reference investors poured 2.6 billion into it after its 80% growth. And then they saw, the fund sink and 750 million, left the fund. Anyway, I think it was also interesting in the article that it referenced the fact that there was another strategy, was an emerging markets bond that averaged, about 8 to 10% over that time period. And most of the investors in that only trailed about a percent. And the difference was in this strategy was mostly institutional investors, which have a more disciplined process than most individual investors have. So anyway, I can't emphasize enough how important it is to have, sound behavior, invest in strategies that you can, stick with. Don't invest on emotion. It almost always results in a bad outcome. Can't emphasize it enough. Okay, well, I hope you enjoyed today's message. Thank you and have a great day.